Welcome back. Now, with APRA putting pressure on the banks to ration out loans, we'll be talking to Steve Mitchell in a moment, but before then, we'll cross to our CBD studio to talk to David Buckland from Montgomery Investment Management about what he's seeing in the market right now. David, thanks for joining us.
My pleasure, Peter.
Now, David, we're starting to see some signs that mid-caps are starting to do pretty well. I think they're up 7.1% for the year, 1.7% for April. Small caps are still struggling, down 0.3% for April, but up 1.2% for the year. With a fund like yours, or like your funds, you would love to see the mid-caps and the small caps start making a really nice comeback, wouldn't you?
Yes, Peter. So what we saw in the last really 14 months was this massive move into the resource sector, particularly when China hit its lows about January last year. And so we've really had a two-speed market. It's been very much resource-driven over the last 14 months. And then what happened was the major banks jumped on board and gave us a super return. And as you probably know, Montgomery Investment Management has been massively underweight the banks, and we have no resources. So we've underperformed quite dramatically in the last 12 months. But I'm actually seeing a bit of a sort of a return to normalcy, Peter, where the resources are just starting to come off the boil and quite aggressively just in the last little while. And then the major banks, I suspect this half year to March 31 will be the absolute low for their provision for bad and doubtful debts. And I actually see those provisioning for bad and doubtful debts picking up quite aggressively from the September half year.
Now, I know that a number of companies have done very well in your portfolio, but the poster child for your tough time last year, of course, was Isentia, but it had some good news this week. Is it temporary good news, or do you think it's a sign of things to come?
I think it's definitely a sign of things to come. The biggest issue for investors in Isentia is their major competitor, Meltwater, had a bit of a price advantage over them. And that really hurt Isentia quite aggressively in the latter part of last year and the early part of this year. Now, I think that's the reverse somewhat, and John Kroll recently spoke at the Macquarie conference and released a very full presentation, and I think it was about slide 18 or 19. It seemed to me they're winning back a lot of contracts or a lot of major clients. They're doing quite well in Asia, and it seems to me that they've somewhat got their mojo back.
Okay, so what else are you seeing out there at the moment, companies that you like, that actually are starting to show some potential?
Look, I would actually say, Peter, I know we've talked about this for a couple of years now, but as you well know, the market gave, at the All Ordinaries Index level, gave 6,000 points a nudge April 2 years ago, and it gave 6,000 points a nudge in the last few weeks. And it really has had trouble in the last couple of years getting through that 6,000 points. And I reckon one of the reasons is simply the market's pretty expensive. And obviously interest rates are dead low, and wages growth's dead low. And there's now disaster scenarios about the whole price of housing and apartments and things like that in the papers every day. So I do feel that the market is at the expensive side of the spectrum. But within that, we still like a number of industrial businesses, and examples include at the small end, or smaller end, I should say, Healthscope, a business called BWX, and that makes sort of very natural product for the cosmetics industry, and has just broken to the UK in a fairly significant way, and got Boots, which is the major pharmacy group, have taken the BWX products on, which is called Sukin, and we think that could be a very, very exciting sort of growth business over the medium term. Other medium-sized businesses we like are Monash and Virtus, which is the IVF industry players, and what happened was they had a very slow December half year, but we think this is an industry that generally grows at about 4% per annum over the very long haul. And of course there are some bad half years and some good half years, but that 4% has been around for a decade or two now. So there's a handful there, but that's in context of a market that we feel is a bit on the expensive side of neutral, Peter.
Yeah. So do you make predictions? I know you wouldn't sort of publicly come out and make predictions, but in your discussion in your investment committee meetings about where you suspect the index might go, And if that happens, will there be various companies that might suffer as a consequence of the index falling, but that they themselves as companies then become great buying opportunities?
Look, as you know, we're bottom-up stock pickers, so we really try and stay focused on sort of quality, and that's deemed to be strategic value, high return on invested capital, high return on incremental invested capital, low indebtedness, fairly reliable cash flow type businesses. So we don't obsess about the 6,000 points or the 5,000 points or the 7,000 points. What we obsess about is trying to pick up those high quality stocks at the right price with the good prospects. Now, the problem we're having, and we've had for quite some time now, is that there's just not plentiful supply at the moment. And so, to be candid with you, if this banking sector gets a bit of a kicking or the resource sector gets a bit of a kicking, then I think, maybe there'll be some other stocks that'll fall in sympathy, and that will definitely provide some opportunities.
Yeah. There was a time, at least one time in Roger's career with me, that he liked the odd mining services company.
Yes.
But are there any mining services companies that have come back on your radar screen?
No. Basically what happened was the mining services companies did particularly well when all the major mining houses and even the second-line mining houses were expanding like Billy-O. And that really ceased about 3 to 4 years ago. And we made a sort of a company-wide decision 3 or 4 years ago just to exit completely on the basis that the easy fruit had been picked in terms of the massive capex that went into particularly oil, gas and iron ore, and coal, I guess. Those 3 or 4 sectors saw, oodles of money spent on them. And now what's happening is the miners are really just tinkering at the sides. The big spend is really now over. And what we're actually seeing is that sort of big infrastructure spend now is coming through, but the mining spend really is really just tinkering at the side.
Okay, one last one, David.
Yes, Peter.
A, do you think the Aus dollar over the course of a year is going to go lower? And if so, are there any companies that you'd like because of the currency development?
Yeah, I think we're going to see the currency with a 6 in front of it before the year out. The reason for that is I think there is going to be a very aggressive slowdown in the whole building space over the next 12 to 18 months, and particularly high-rise, high-density of the apartment market. I think that space will be in some trouble over the next 12 to 18 months. And I think that what happens is that's quite a large employer. I think the other thing is that Amazon is coming next year, and that'll put a certain amount of pressure on the retailers. And we were just talking with Rudy earlier how the retailers are getting bashed up a bit in anticipation of the Amazon effect. But 10% of our population is employed in retail, and a very big chunk is employed in buildings. So I see some areas that are quite ugly over the next 12 to 18 months. And in anticipation of that, I think the Australian dollar will fall with a 6 in front of it. And in anticipation of that, I think any half-decent quality industrial company that has good global revenue will, enjoy the declining Australian dollar.
All right, mate. Thanks for joining us.
My pleasure, Peter. Thanks for your time.
David Buckland.